Welcome back. It's another episode of Solopreneur Survival Club. Today we are talking about income statements. How exciting. No one likes it, but we all have to know what this stuff is. You might also hear them called like profit and loss statements. It's one of the two core financial statements that you see in your business. The other one is your balance sheet. I'll do another episode about that one once it's out. I'll link to it in the show notes here. Income statement is, regardless if you're a corporation or a sole proprietor, this is the statement that defines your business. No pressure, right? Your income statement ultimately has kind of three main sections to it. So it's going to show your revenues, your cost of goods sold, and then your expenses or your overhead. Bottom line number being that profit number. So let's dive into each of these. In the revenue side of things, this is where you're going to kind of be showing all of your sales from either your products or services. You can just report this as one line, or you can break it down. Some of my clients, we just do it as one line. Others, we break it into, if they've got wholesale sales, we put that in one line, and retail or direct to consumer sales would be in a different line. So we can kind of see those numbers over time and how they change and hopefully grow. So that's kind of your main sources of income. Other incomes that you might have are things like interest income. So if you have balances in a bank account that are earning interest, you'd have income coming from that. You might get grants or subsidies, from the governments or whatever it may be, youth employment, student work grants and things like that for different applications or kind of scholarship type things that you've applied for. You also might have in your sales is money that you earned from sales of an asset. So if you had a piece of equipment you'd been using, you bought the new and improved version, but you sold the old one, you would have revenue coming in from that sale. So any sale of assets, whether it's, equipment, materials, whatever it may be, that's also reported in your revenues. The one thing that you're not going to include in things like revenues is money that you maybe got through a loan, or friends or family may have lent you some money to help you through a cash flow crisis. So that kind of money does not get reported as revenue. That gets reported in a different spot. So things like that, we don't worry about. Money that you might have put into your business, that's not money that's reported as revenue because it's not from sales of a product or service or assets. Just to make sure that you kind of keep that side out of it. Once you have your revenue number, that's great and lovely. We don't want to pay taxes on that revenue number because, we'd be paying way too much. So we then want to look at what it costs us to provide those services or that product. So the first section that we look at is our cost of goods sold. So cost of goods is those expenses that go directly to the production of or delivery of your service. For me, for instance, in my other business, Clear Eyes Consulting, we provide bookkeeping and tax services. So for me, there really isn't a lot of direct costs. The biggest costs that I have that I report in cost of goods sold are the subscriptions that I pay for my clients. So things like QuickBooks Online, Daxed, WagePoint for payroll, different things like that. If I didn't have those clients, I would not have those subscription costs. That's for me what would be in cost of goods. If you're a service-based business, you might not have really much in here. If you're a product-based business and you're creating or delivering an actual thing to people, these costs will be a lot more. In your cost of goods, you might have things like if you buy inventory that you resell to others, that would be in your cost of goods sold. You might have all the materials that you buy to create your product or service. Those are different things that you would include in that section of your income statement. When we take our revenue less our cost of goods, that will give us our gross profit. It's not gross. It's just, it's not ick gross. It's just called gross profit because it's the difference between our revenue and our cost of goods. And that gross profit is really what then defines how much money we have to cover the rest of the stuff. The rest of the stuff is all of our other expenses, or what we might call our overhead expenses. So while our cost of goods, if we never produced another widget, again, those costs would be zero. Our overhead costs, our expenses are going to be those costs that we're going to incur regardless of whether we sell 1,000 or 1 million of whatever we're doing. So in that overhead cost, we're going to be looking at things like rent, utilities, subscription costs, salaries if we have employees or contractors that work for us. These are costs that have to get paid. The more we grow, the more that overhead piece tends to grow. So we need our sales to continue growing in order to cover that. One of the things that we want to ensure and clarify that isn't one of your overhead expenses is going to be things like credit card payments. That's not an expense because the expenses are captured for the actual things that you bought. So that payment that you made to a credit card is not considered an expense. Loan payments are not considered expenses because again, you're capturing the expenses for what you spend that loan money on, and repaying it isn't an expense. That's captured on our balance sheet. Another one would be, for instance, if you're buying a new asset or that new piece of equipment that we were talking about, or a new computer, new phone, whatever it might be. Those like big purchases, anything really over $500 doesn't land on your income statement. Those are considered assets. They have a life longer than a year. And so we record those purchases on your balance sheet as an asset. And every year we prepare taxes, we take a little piece of that purchase and apply it to your income statement. It's called amortization or depreciation. Instead of, a $3,000 computer being expensed in 1 year, we can take that $3,000 computer and expense $1,000 over the next 3 years. So we help spread those big costs over the course of several years. And there's different rules for whatever you bought for how long we can expense it. But that's how we deal with some of those things. So that's why you might be like, well, I bought all this stuff, in 2020, whatever, and why is it not lowering my taxes? It's because of that whole asset and depreciation side of things. The other thing that expenses that you won't see on your income statement might be things like dividends or just payments to yourself. If you're not set up as an employee and running payroll and remitting taxes every, whatever pay period and things like that, then ultimately what you're doing is taking dividends or doing distributions if you're a sole proprietor. This money, unfortunately, isn't expenses. It's not like payroll. It's you taking money from your business, and eventually you'll pay personal taxes on it and have it reported. But for the purposes of your business and expense deductions, unfortunately, that can't be deducted. Only legit payroll can get deducted, which requires a whole other set of things. I think those are the big ones that people often confuse with, we've spent all this money, but why isn't it showing up on our income statement? Loans in particular are ones, whether it's private loans, bank loans, private loans to friends or family, all those. I get that you're taking money out of your bank account and spending it somewhere, but they're not considered expenses. At the end of the day, when we take our gross profit amount and take off all the overhead pieces, what's left over, that becomes our net profit. And that net profit is that ultimate number that we use in order to figure out how much taxes you owe. One of the biggest things that I try to do with my clients is ensuring that we're not missing out on any of the expenses, whether it's in cost of goods or our overhead expenses, to help us reduce that profit. Of course, as entrepreneurs, we want to be like, yeah, we're making so much money, la, 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 la. But when it comes to reporting that money to the feds, we don't want to, the more we report, the more we have to pay them. So ensuring that we're capturing every single possible expense legitimate expenses is really important. One of the other things that often comes up when I'm working with clients, especially year end and tax time and stuff, is I put together their income statement and we show a profit of X dollar. And generally speaking, the first question that comes to their mind is, how did I make X dollars? My bank account is empty. I get it. The reason that your profit on an income statement doesn't necessarily align with what's in your bank account is because of one main thing. It's the timing of money and the invention of credit. So what happens on our income statement is that we're showing money, sales that have been invoiced, maybe not necessarily paid. We're showing expenses that have been billed to us, but not necessarily paid for. We're not showing any of the other money in and out that's been happening. So money, maybe you transferring money to yourself as part of your pay, or money that you or a bank or friends or family are sending to you to help supplement your bank account because you needed it to pay bills. So your bank account is only a small piece. The other aspect that it's not showing is there may be expenses on your income statement that you've charged to a credit card, and that credit card isn't paid off. So different things like that can really impact how your income statement is usually a giant difference from your bank account. That's why it's really important to make sure that you're putting money away based on your income statement to prepare for taxes, not based on your bank account. I did an episode about moving money and making sure that you're squirreling money away. I'll link to it below. Listen for what you can do to kind of squirrel some money away and keep that off to the side so that you're prepared for tax time. So when we're looking at an income statement, if it's the end of the year and the person doing your taxes, or you, if you're that person, you prepared your income statement, you're looking through, what should you be looking for? When I'm going through this for my business or with my clients, I look for different things. On the revenue side, you're going to want to look to ensure that the amounts are correct. You're the one kind of in the day-to-day of your business. You want to ensure that the money that's reported there does not include any sales tax. There should be no sales tax included in anything that gets reported on something else. So making sure that there's no sales tax reported in your revenue numbers is going to be important. So on your income statement, otherwise you're going to be reporting 5 to 15% more income than you actually had. That's one thing, making sure those numbers are correct, looking for any outliers of sales and things like that, that maybe was double entered or those sorts of things. If you have a separate point of sale system like Square or Shopify or things like that, running a quick report to make sure that the numbers make sense is a good idea. So that's why I would look on the revenue side of things. I would wonder and question any negative numbers that you see in there, because there shouldn't be negative numbers. It just probably means there's something in the wrong category. Your cost of goods, I look to see, again, do those numbers make sense? Generally speaking, your cost of goods sold should be well below 50% of your sales. Why? Because your cost of goods is basically how much it costs you to make that thing. If your cost of goods sold is more than 50% of your revenue, that means a couple of things. One, maybe your prices aren't high enough to cover your product costs, as well as the extra money needs to go to cover all the overhead. Maybe there's something in there that shouldn't be, in the sense that, do you have a bunch of stock sitting there, but you're expensing it, and maybe you can save that for a future year of expenses, because that cost of goods should be the cost of selling the items that you sold, not necessarily future items as well. So looking, at that gross profit and making sure that you've got there is numbers in there. There is a positive number in there. That's important. Then going through all of your overhead, I would look through each line item and give it a gut test. Is your shipping costs 5 times more than you thought it was? Are your salaries and wages super low for some reason? Is there something missing? Or, things get miscategorized somewhere along the way. Usually by the time you're looking through these income statements, if you're just doing it once a year at tax time, it's too late to do anything about it. Yes, you might be able to recategorize some stuff, but at the end of the day, the numbers are the numbers. I really encourage you, if you've got the ability, to be looking at these numbers on a consistent basis. So monthly would be lovely. Quarterly would be just as good. Because at that point, when you're looking through and you start seeing like crazy numbers for something like shipping, for instance, it's, a huge percentage of your income. Maybe that's a trigger point for you to start investigating some different options. Or it might be a trigger point to say, okay, I need to start charging more for my shipping because I'm not recovering these costs. So being able to check in on your income statement throughout the year can really help you to redirect your energy and focus in on some of those big spending categories that are maybe tanking your ability to kind of grow your business. I would spend a lot of time looking through some of those line items and understanding what they mean and understanding kind of your role in creating those. Because, I mean, obviously, at the end of the day, you're the one spending it, or someone on your team is. What is happening in your business that is getting, making you think that you need those things or whatever? And sometimes we need them. We need to ship our products out, whatever it may be. But it could be a point where we maybe need to look at our pricing or our different processes. Maybe if our salaries and contract fees are out of whack, maybe there's some different work that we can do around setting up more streamlined systems and processes so that people aren't spending so much time on tasks that should be quick and easy. I would go through, look at each different line item, question them, not necessarily that they're not legit, but question them in the sense of why are they what they are? What could we be doing differently to help manage those costs and get them within a reasonable amount that makes a bit more sense for you? And then looking, of course, at your profit, being able to see what that number is, and then taking that step back to see, okay, how can I get profitable? Or how can I increase my profit? And that's really getting into the details of where are you spending your money? Why are you spending it that way? What's contributing to, like I said, maybe, too much time, you don't have systems in place, supply, there might be better and more cost-effective suppliers out there that can help you, or it might be a pricing issue. There's lots of different factors, and really being able to go through and dive into that income statement is one of the best ways to start that investigation. It's a process, but with a lot of consistency and attention to it, you can get in some great habits around refining your business and getting to that place where you're, coming out of the weeds and being able to get to a place of profit. So there you have it. Go to your friendly neighborhood bookkeeper or accountant, or dig out that spreadsheet, however you're doing it, look at your income statement. Take a peek, start investigating, start asking the questions. And as always, if you want to dive into it together, just reach out. My details will be below, and I'd love to help you through it. Have a great week, guys.